All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is July 2nd, 2025, and it's been kind of a hectic morning. We had some news broke over the last hour or so, and I've been kind of scrambling here to get this show ready at the last minute. We got two big ones going on this morning. The first one, ADP private payrolls came out. Now, ADP, the private payrolls number, this is private data. It's not a government institution. It is historically known for, I don't want to say being inaccurate, but it doesn't always line up with the non-farm payrolls, the government jobs report number that we're going to get tomorrow. We would typically get it on a Friday, but because of the 4th of July weekend, we're getting the jobs report tomorrow. Now, ADP is usually viewed as a preview for that. And again, it tends to vary wildly. I want to put that big asterisk here. But we got a really big surprise to the downside from ADP this morning. Private payrolls were reported as a loss of 33,000 jobs for the month of June. Now, that is versus expectations for a gain of about 100,000 jobs. That's a huge deviation from expectations, and the market reacted to that. Stocks were kind of treading evenly, headed a little bit lower on that news. So we've got some people who are adjusting their expectations for that non-farm payrolls report that we're going to get tomorrow. Now, this comes a day after we got some labor data yesterday that actually looked pretty good. We got the JOLTS report, Job Openings and Labor Turnover Survey. That measures the number of job positions posted in the U.S. That was higher than expected. Higher than it was last week. The job quits number was a little higher than expected. Typically, people quitting their job indicates strength in the labor market because they believe they can find another job elsewhere. So both of those data points, they weren't great, but they were good yesterday. So that's a little contrary to this ADP number that's got people scratching their heads this morning. We also got challenger job cuts came in a little bit lower than expected. Not as many layoffs last month. We also got the Macro Edge job cuts tracker, which is very similar to the challenger number. That came in a little bit lower than previous months. So we've had some relatively strong labor data leading up to this morning. And then all of a sudden this ADP number comes out and everybody's like, whoa, what just happened there? What is this telling us? And so we won't really know for sure until we get that non-farm payrolls number tomorrow. And even then, guys, I have to warn you, the non-farm payrolls number can be deceptive. The market just takes that headline number and they run with it and they say strong jobs market. And then you usually get big downward revisions to prior months. And then, of course, you have to open up the jobs report and look at what's actually going on in there. Did we lose full-time jobs and replace them with BS part-time jobs and gig work like we've done for the last 2 years? And look, guys, the job market, the health in the job market is vital right now because that's going to determine whether we enter an official recession, even though if you ask the average person, we've been in a recession since 2022. I think that's almost universal outside of Wall Street. But the other thing the jobs market is important is it's going to inform what the Federal Reserve does. And right now we are on a path to return to Zerpenber at some point. And so a strong jobs report tomorrow might throw some cold water on plans for Fed rate cuts. A weak jobs report tomorrow might say, oh, the Fed's going to cut sooner. So then the question becomes, is this going to be one of those bad news is really good news for stocks kind of stories where everybody runs out and buys stocks because of a bad jobs report because the Fed is going to Zerpenber sooner? A lot is going to happen over the next 24 to 48 hours that is worth watching as we head into this long weekend. Now, another thing that's really important, and this hit right as I was posting the stream this morning, I had to change the title at the last minute. We've got borrowing costs in the United Kingdom just suddenly spiked this morning. More than 20 basis points for the UK's 10-year gilt. That's like their 10-year treasury bond. This is happening very quick, and this is eerily reminiscent to what happened in the fall of 2022. You may recall the Gilt Crisis, the original Gilt Crisis that happened back then, brought the administration of Prime Minister Liz Truss to an abrupt end when borrowing costs spiked. Now, in the fall of 2022, that was because of tax cuts that Liz Truss was planning that were going to increase the deficit in the UK. And of course, the bond market freaked out. Hey, you're going to borrow all this money to fund tax cuts. Well, we want a higher interest rate because we're starting to wonder if you can pay us back. And so Liz Truss, she was out of there. They canceled those plans. Also, the Bank of England had to abruptly start printing pounds in the middle of the night and start buying up those bonds to bid up their prices and send the interest rates lower. It was a debt crisis. It was a liquidity crisis in the UK bond market. It almost torpedoed the entire UK pension system. That was a very big deal. I think the average person in the UK doesn't realize quite how close they came during that gilt crisis. Well, it looks like that could be happening again. Now, early innings here, I don't want to get too excited, too doomy with this. We don't know what's going to happen. We don't know what central bankers are going to do. But there was a bill passed in the UK Parliament yesterday. It was supposed to be a welfare reform bill. The UK has a big welfare problem. 1 in 10 adults of working age in the United Kingdom is on some kind of welfare assistance. That's freaking ridiculous. 1 in 10 working age people is on the government dole. You got to be freaking kidding me, guys. Y'all got a welfare problem over there. And yes, I understand we have the same problem here in the United States. It's almost universal in the West. The entitlement state has run out of control. Now, this welfare reform bill that passed in the UK yesterday, at the last minute, there was this rebellion among the ruling Labour Party. That's their Liberal Party. And they're like, no, strip out all the spending cuts that were in the bill. And then it passes at the last minutes. And the bond market says, whoa, back the truck up. You guys said you were going to be cutting spending in the bill. And then you didn't at the last minute. You took out anything that was going to cut any spending. Gee, is there something similar happening here in the United States that maybe we should be worrying about right now? Some big, beautiful thing happening? But I digress. And so UK borrowing costs are skyrocketing right now. And if they're not careful, they're going to end up right back where they were in October of 2022, where the central bank has to start printing money again. Yo, guys, the inflation is coming back. The government cannot get their act together anywhere in the world. They cannot cut spending. And every time they fail to cut spending, the central banks ride to the rescue. They lower interest rates and they print money. And that's what causes the inflation, which makes more people dependent on the government for handouts. Rinse, repeat. We are trapped in this doom loop. We have got to cut spending. And by we, I mean freaking everybody everywhere. And it's just not happening. Now, you might be saying, oh, all they need to do is tax the rich in the UK. I get this all the time. We don't have the taxes or aren't high enough. The government needs to take even more money from people. You may have noticed the UK already did that. Keir Starmer and the Labour Party passed a big tax reform bill, and all the millionaires freaking left the UK. They're gone. All the big tax benefits that they were going to say, oh, we're going to get all this money from the rich. We're going to tax them. Nope. They took their money and they left. And now you got no rich people to tax anymore. So it's not a tax problem. It's a freaking spending problem, right? 1 in 10 working age people on welfare. Who TF are you kidding with that noise? So we'll take a look at the charts and what those are telling us this morning. We've also got some moves in the trade war happening this morning. Foxconn has abruptly pulled Chinese workers from factories in India. That's kind of interesting because Foxconn, it's a Taiwanese company, but the Chinese government isn't keen on Foxconn building these factories in India to basically take manufacturing out of China. And so Foxconn ordered their Chinese workers to go home, even though the Taiwanese workers are staying there. This kind of reeks of the CCP. Obviously, something going on there in the trade war. Japan has planted their feet in trade negotiations. They want U.S. tariffs gone away. They especially don't want the tariffs on autos. And because they planted their feet, they're apparently not being very forthcoming in negotiations. And President Trump is throwing a fit and saying, you know what? I think we're just going to put 35% tariffs on Japan. So we've got a little bit more brinksmanship going on between Japan and the U.S. That July 9th deadline that they've already kind of signaled they're flexible on is coming up. So Japan's kind of betting that Trump is going to taco again here. We'll see what happens there. U.S. weapons shipments bound for Ukraine were just halted. That's interesting. We got a whole pallets full of Hellfire missiles and Patriot missiles and Stinger missiles, basically air defense and ground attack munitions, all being held up in Poland this morning. Now, the story that is being posted or that's being spun here is that U.S. stockpiles are depleted and we can't manufacture our weapons fast enough. That is not necessarily new news. We've had that problem for a while. We've been talking about it a lot on this channel. Also, the situation with the trade war with China and their unwillingness to sell us rare earth metals, which should have been resolved based on some of these recent trade deals, not deals that were cut. That's a lingering risk for the U.S. defense industrial complex. Whatever is going on here, they said, you know what, leave those weapons in Poland for now. I suspect this might actually have something to do with some back channel negotiations going on with the Russians. I could be wrong about that. But at the end of the day, the Ukrainians want the missiles and they're not getting them. We've also got Microsoft is cutting jobs to pay for their build out of AI infrastructure, but then it's what they're doing after they cut those jobs here in the US. That's kind of interesting. Some people are calling them out on that. And canned food maker Del Monte has filed Chapter 11 bankruptcy. Another one bites the dust. We'll talk about that one this morning, guys. There is a lot going on here. Why don't we shrink my big melon of a head and let's see what's happening in the world of finance. And hey, don't forget that like button and that subscribe button for the algorithm so you can come back and have your coffee with the melon heads every single day that we do this one. And right now, the S&P 500 is slightly negative here. Emphasis slightly down only 5 points, 0.07% here. But you will notice a lot of that came over the last half hour or so, or the last hour when we got that ADP news. And I think that story going on in the UK probably could affect the US bond market as well. Now, interesting thing about the S&P 500, however, I wanted to point out, this is now a long-term chart of the S&P looking at daily candles going back to the beginning of last year. And I would just draw your attention to this little phenomenon here. What you're looking at in blue, that's the 50-day moving average, and in red is the 200-day moving average. And you may notice the blue line crosseth the red line. That is known as a golden cross, which is a majorly bullish technical indicator. That happened yesterday. A golden cross in the S&P 500 as the S&P sits at all-time highs. And I would just point out the last time the S&P 500 made a golden cross was all the way back in January of 2023. And at the point, the S&P 500 was about 4,200. And we proceeded to rally, about 2,000 points, almost 50% off those levels. So an interesting technical indicator hit yesterday. Meanwhile, the Dow is lower by 23 points here, or 0.05% to the downside this morning. And the NASDAQ is lower by 43 points, or 0.2% lower. You'll note the NASDAQ is lower by considerably more than the Dow. Yesterday, the NASDAQ was red. The Dow was positive. Possible for the second half of this year, we got a little bit of sector rotation, maybe some selling in tech and people buying some of the perceived to be safer names in the Dow after tech outperformed in the first half of this year. Meanwhile, the U.S. dollar is higher this morning, still just slightly below that 97 threshold here, up by 32 basis points, 96.96 for the DXY. Let's move past the Dixie right now, and let's look at the bond market because that's where the fireworks are this morning. Now, the 30-year U.S. Treasury, 4.825. That's higher a little bit this morning, almost 5 basis points. The 10-year yield is at 4.294, also higher by 4 basis points. So the long end of the yield curve, prices moving lower, sending yields higher here. The 2-year Treasury, 3.766. That's lower by 1 point. And the 1 month is at 4.271, actually higher by 1 point. But it's not so much what's going on in the U.S. in the bond market that's important this morning. Take a look here when we scroll up to the UK bond market and look at some of the moves here. The UK 50-year gilt up 19 basis points. The 20-year also 19. The 10-year gilt up 17.5 points. The big mover here, the 25-year up 20 basis points. The long end of the yield curve in the UK is blowing out here. People are dumping UK government bonds. I don't know what they're buying, but they're getting out of UK debt. That's causing their prices to head sharply lower and their yields to head sharply higher. So let's talk about this one. This is an Invest. This might be some AI website. I don't know, but it's actually a pretty concise and accurate description of what's going on here. UK gilts in the crosshairs, fiscal credibility and the cost of Starmer's retreat. The abrupt reversal of Keir Starmer's welfare reforms in June of 2025 has exposed deepening fissures in the UK government's fiscal credibility, with profound implication for sovereign debt markets. The retreat, driven by internal Labour Party dissent, has reignited concerns over the sustainability of public finances, pushing UK government bond yields to multi-decade highs and testing the patience of fixed income investors. For holders of gilts, the question is no longer whether fiscal slippage will occur, but how markets will price the risks of prolonged policy instability. In other words, the UK has a big spending problem. They're doing nothing about it. And we're just wondering, what are the bond investors going to have to say about that? And right now they say sell. The Starmer government's welfare U-turn marks a critical inflection point. Originally, the welfare reform bill aimed to trim £5 billion in annual welfare spending, but concessions to rebellious Labour MPs reduced projected savings to nearly zero. The shelving of cuts to the Personal Independence Payment, or PIP, a central plank of the plan, not only erased £2.5 billion in savings, but also created a £6 billion funding gap for Chancellor Rachel Reeves. This shortfall, coupled with the government's reliance on last-minute compromises, has eroded trust in its ability to manage fiscal discipline. Historically, such reversals have been catastrophic for bond markets. The 2022 mini-budget fiasco, which briefly pushed UK 10-year yields to 4.8%, serves as a cautionary tale, yet today's environment is even more perilous. Unlike 2022, the UK now faces a structural deficit exacerbated by rising utility costs, stagnant wage growth, and the Bank of England's delayed exit from post-pandemic monetary easing. The widening spread between UK gilts and their German peers, now exceeding 200 basis points, reflects investors' growing risk aversion. Short story here, guys. The UK has a big spending problem. They're not doing anything about it, and the bond market is throwing a fit. Take a look at the yields in the UK government's 10-year gilt here. Now, they're down off their lows, or I should say off their highs. It's this big green candle that's happening this morning here, guys. There was a big step change in those bond yields. We went as high, what was the high this morning of hold on here. We went as high as 4.681 this morning. A big move higher, guys. And look, the last time, let's just zoom way out here. So, yep, we're higher than we were back in 2022. But here is the UK gilt market crisis. It actually took place over a span of several months when we saw those yields blow out pretty high, culminating at the end of September when they reached 4.6%. We're higher than that level now. Ultimately, Liz Truss resigned. The Bank of England printed money, bought the UK gilts. That put the immediate crisis to bed. It exposed problems with liability-driven investment, the pension scheme that's used in the UK and used here in the States. And the problem, guys, if you look, interest rates are now higher than we were back then during that crisis. And it looks like they're getting ready to break out above these levels. Let me just get my pen back here. You know, we hit this level and then, okay, the UK printed the money. We came back. We hit that level again. We managed to get out. And now, look, we're flirting with this level again here, guys. Long-term borrowing costs are going higher. It doesn't matter what the central banks do. Ultimately, those long-term borrowing costs are determined by bond investors who see inflation going higher and they want a higher interest rate in exchange for locking their money up. That means the government's got to pay. And that means the debt problem gets worse. Guys, you got to cut this freaking spending. Pay attention, U.S. Congress. It's coming for you as well. Now, let's look over at the commodities board here. We've got gold is a little bit higher this morning, 3,343 for spot gold. That's up by about $4 or 0.13%. Spot silver continuing to run here, 36.28. That's higher by another quarter this morning, or about 0.7% higher. I like the shiny. Watch that gold to silver ratio as silver outperforms gold. Still historically very high. Silver has room to run. I had to cut it because of the UK bond story that hit at the last minute, guys. But there was an excellent article in Market Watch about silver prices today. Echoes a lot of what I've been saying on this channel. Meanwhile, copper prices higher by 2%, platinum higher by 2.75%, palladium higher by almost 2.8%, and even crude oil is higher here. We've got commodities, a lot of green. Crude oil for August WTI futures, $66.11. That's higher by 66 cents. And looks like Bitcoin is a little bit higher this morning as well. $107,559 is priced on Coinbase. That's higher by about $1,800 versus yesterday. Still range bound between 105 and 110, where we've been for a few weeks here. All right, now let's talk about what's going on in the jobs market here. The private sector lost 33,000 jobs in June, badly missing expectations for a 100,000 job increase, ADP says. Private sector hiring unexpectedly contracted in June. Payrolls processing firm ADP said Wednesday, in a possible sign that the economy may not be as sturdy that investors believe as they bid the S&P 500 back up to record territory to end the month. Private payrolls lost 33,000 jobs in June. The ADP report showed economists polled by Dow Jones forecast an increase of 100,000 for the month. The May job growth figure was revised even lower to 29,000 jobs, added from 37,000. So besides that loss of 33,000 jobs, you've also got an 8,000 job cut to last month's number. Not so good for the ADP number. Though layoffs continue to be rare, a hesitancy to hire and a reluctance to replace departing workers led to job losses last month, said Nella Richardson, ADP's chief economist, in the press release. To be sure, the ADP report has a spotty track record on predicting the subsequent government jobs report, which investors tend to weigh more heavily. May's soft ADP data ended up differing significantly from the monthly jobs report figures that came out later in the week. I disagree that those monthly jobs report numbers were really any good last week. The headline number was good, but the downward revisions erased all those gains. This week, the government's non-farm payrolls report will be out on Thursday, with economists expecting a healthy 110,000 job increase for June per Dow Jones estimates. Economists are expecting the unemployment rate to tick higher to 4.3% from 4.2%. You may recall last month we were right about the cutoff. We were at like 4.249, right where we would round up to 4.3. So we'll probably go into 4.3% this month. Some economists could revise down their jobs report estimates following the ADP data. Meanwhile, yesterday we got the JOLTS report. This is the ADP number. Here's the JOLTS report. Job openings in the United States rose by 374,000 to 7.769 million in May of 2025. That's the highest level since November of 2024 and well above expectations for 7.3 million. The largest gains were seen in accommodation and food service, i.e. low-wage part-time jobs, which added 314,000 openings, followed by finance and insurance with an increase of 91,000. Those tend to be better-paying jobs. In contrast, job openings in the federal government declined by 39,000. So here is the JOLTS number here, 7.77 million, up from 7.39 million. And let's just take a look at a 5-year chart of the JOLTS opening here. You can see we fell pretty sharply during the quantitative tightening after that huge rise post-pandemic and the Great Resignation. But now we've kind of leveled off, and this may actually show some slight signs of trending upward. But a lot of people have cast a lot of doubt on the JOLTS openings, guys. Because of work from home, we've got duplicate job postings in multiple cities. There's a lot of ghost jobs being posted, companies that are posting jobs just in case a good candidate comes along, but they really have no intention of hiring. So a lot of people say that this is not really that good of a data point anymore. Now, we also got job quits yesterday. The number of quits in the U.S. rose by 78,000 to 3.293 million in May. That's from an upwardly revised 3.215 million in April, but below 3.355 million a year ago. Now, the quits rate is usually an indicator that people believe the job market is stronger. They're quitting their job because they think they can get another job somewhere else or a better job. So this slight uptick in quits, that's a good indicator for the job market as well. So you can see here the JOLTS numbers, the quits numbers differ pretty dramatically from what ADP just gave us. What are we going to get when we look at that non-farm payrolls report tomorrow? It's anybody's guess. Now, here's Challenger job cuts. This measures the amount of layoffs and job cuts announced in the United States. Big decline in that, just 48,000 job cuts announced for the month of June, down from 93.8 thousand in the month of May. We hit a high in March of 275,000. So the number of layoffs down significantly. And my friends over at MacroEdge, they're seeing the same thing with their own job cuts tracker. The June MacroEdge job cuts tracker showed 85,902 job cuts final, decreased slightly year over year as public announcements decreased from major companies. Announcements of smaller cuts remain elevated along with bankruptcies and business closures. Shout out to my friends at MacroEdge on Twitter. I highly suggest you follow them. All right, we got some trade war news going on here. Foxconn pulls Chinese staff from India in a hurdle for Apple. Apple has been trying to move their iPhone production to India all year, and, well, the Chinese may have something to say about that. Foxconn Technology Group has asked hundreds of Chinese engineers and technicians to return home from its iPhone factories in India, dealing a blow to Apple's manufacturing push in the South Asian country. The bulk of Foxconn's Chinese staff at iPhone plants in southern India have been told to fly back in a move that began about 2 months ago, people familiar with the matter said, asking not to be named as information is private. More than 300 Chinese workers have left, and mostly support staff from Taiwan remain in India, one of the people said. It's not immediately clear why Apple's biggest iPhone assembler sent the workers home. Earlier this year, officials in Beijing verbally encouraged regulatory agencies and local governments to curb technology transfers and equipment exports to India and Southeast Asia in what is a potential attempt to prevent companies from shifting manufacturing elsewhere. Apple CEO Tim Cook has lauded the skill and expertise of Chinese assembly workers, highlighting it as a key reason, not just more favorable cost, for setting up the majority of Apple's production in the country. Apple continues to fillet Chinese Communist Party members at every turn. Their removal from India will not impact the quality of production, but it's likely to affect efficiency on the assembly line, according to one of the people. Still, the change comes at a bad time for Apple as it is preparing to ramp up production of the new iPhone 17 with its manufacturing partners in India. Foxconn is in the process of building a new iPhone plant in southern India. Now, look, Foxconn is a Taiwanese company. They're listed in Taiwan. They were founded and largely owned by a Taiwanese guy, but they have a lot of operations in China. So Foxconn has to walk that fine line between Taiwan and China. They're building these factories in India. Apple wants to build their iPhones in India to get around some of the trade war stuff, to get around some of the tariffs. China doesn't want it to happen. So Foxconn is saying, all right, you Chinese guys go home. You Taiwanese guys, you can stay in India. Apple's like, please don't do this. We want to make our iPhones in India. So we'll see what this ultimately results in. It's probably going to take a little while for this to play out. And we've got some Japan trade war news here. Trump's 35% tariff threat feeds Japan's worst case scenario fear. Maybe a little bit of an alarmist headline here, but the tariff talk between the U.S. and Japan has escalated. U.S. President Donald Trump threatened Japan with tariffs of up to 35% as he ramped up tensions for a third straight day, fueling fears of a worst case scenario among market players and raising doubts over Tokyo's tactics in trade talks. Japan has so far stood firm in negotiations over across-the-board reciprocal tariffs, insisting that they be removed along with additional sector tariffs on autos, steel, and aluminum. The car duties are particularly painful for Japan as the industry contributes the equivalent of almost 10% of GDP and employs around 8% of the workforce. And we talked yesterday an awful lot about some of those auto headlines, in particular Nissan, Japanese automaker, is in big trouble over there. These auto tariffs that Trump has placed on Japanese cars are going to hurt them a lot more. Tokyo has insisted that a win-win deal must encompass all of the tariffs in one go, with Ishiba, the Japanese prime minister, preferring no deal to a bad deal ahead of a July 20 upper house election. The prime minister on Wednesday reiterated his view that focusing on jobs and investment in the U.S. was the way forward, just like it was for Nippon Steel, as it patiently sought to change Trump's view and take over U.S. Steel, something that ultimately Nippon was able to do. So Japan and Trump, a little bit of brinksmanship going on here in the tariff war. Trump has already signaled that July 9th deadline is flexible. Japan's planting their feet, saying, go ahead and taco again. We're in no hurry here. Will they place these 35% tariffs on the Japanese, or will they blink again? My gut tells me they'll probably blink again, and I think mostly the market is in agreement with that, because the stock market, you may have noticed, is just going up relentlessly, acting like the trade war is already over, despite freaking out over it in April. And meanwhile, we got more news this morning. U.S. halts key weapons for Ukraine in a new sign of weakening support for Kyiv. Withholding Patriot air defense missiles comes as Ukraine faces persistent Russian air attacks. The U.S. has stopped the delivery of air defense interceptors and other weapons intended for Ukraine, and is using them instead to beef up Pentagon stocks, a Trump administration official and two congressional aides said on Tuesday. The shipments were in Poland when they were being halted and included Patriot air defense interceptors, air-to-air missiles, Hellfire air-to-ground missiles, and surface-to-surface rockets, artillery rounds, and Stinger surface-to-air missiles. Elbridge Colby, the Undersecretary of Defense for Policy at the Pentagon, didn't address the decision to halt weapon shipments to Ukraine, but said the Defense Department would provide President Trump with options to continue military aid to Ukraine that are consistent with his goal of bringing this tragic war to an end. Now, that's kind of interesting, that last sentence there. Consistent with the goal of bringing this tragic war to an end. That would somewhat suggest that maybe this has something to do with talks with the Russians. Maybe this was an overture to the Russians to try to get them to halt the war by saying, okay, we'll give slightly less stuff, or we'll pause our shipments to Ukraine. But at the same time, the U.S. also needs that stuff. The U.S. magazine stockpile has been a major issue. We have been burning through weapons in Yemen, then in Iran, and in Ukraine, weapons that we cannot replace easily because our defense manufacturing base has atrophied over several decades. And of course, we're having trouble rebuilding this stuff because we can't get rare earth magnets from the Chinese as part of the trade war, something that was supposedly fixed a few weeks ago. But we saw some articles last week where the automakers are saying, yo, guys, we're having to maybe pause some production because we can't get these rare earth metals. So it looks like we've got the, what would you call that? Maybe the intersection of several different geopolitical stories all at once wrapped up in here. So it's hard to tell what is the main driver for this one. But at the end of the day, the missiles are stuck in Poland. Meanwhile, we got some interesting news from Microsoft here. Microsoft job cuts point to a squeeze from rising expense of AI. Hey, just keep burning billions of dollars on data centers so chatbots can tell us to glue our pizzas together and just lay off all the people. That's how we're going to do things over at Microsoft. Burning through cash. Microsoft is one of the world's preeminent profit-making machines. It posted more than $96 billion in net income over the last year and has a market cap north of $3.6 trillion. Yet this week, it is expected to fire thousands of workers in a second major round of job cuts this year. Why? In part because artificial intelligence is expensive. After spending tens of billions of dollars on data centers and AI application development, Microsoft pledged to Wall Street that it would put a lid on costs. Across the tech industry, companies are grappling with the spiraling costs of staying up to date in the AI race, whether by training the large language models that underpin the technology, building servers and data centers, or developing AI applications. Some companies are trying to maintain margins by penny pinching in other divisions, while others are accepting it as part of doing business. Okay, so Microsoft laying people off, namely laying off American workers so they can keep building out AI data centers. I got to send a shout out to Amanda Goodall on Twitter, by the way, at the Job Chick on X. And she's correctly calling out Microsoft on this one. She says, whoa, 6,327 H-1B visa requests. That's what Microsoft filed for software engineering roles in Washington. Yes, that is the same month that it laid off 2,300 workers in the state, including 817 software engineers. Same job, same location, lower pay. Is this really about a skills gap? 14,181 total foreign labor requests this year, 82% below market wage, routed through Integron, that's an India outsourcing firm, $3 billion invested in India, 10 million workers being trained in AI in India. Is this a labor arbitrage machine on autopilot? And what the Job Chick is pointing out here, guys, is that, yeah, Microsoft is cutting jobs in America. They're laying people off in order to pay for their AI build out. And then they're turning around and they're filing for H-1B visas that allows them to hire foreign workers at an average 82% of what it costs them to hire an American. And, well, think about the net effect of that. So let's say the government grants all those H-1B visas. Okay, fine. We import labor, which suppresses the cost of labor that we pay for the United States. And by the way, when you suppress U.S. labor costs, you also suppress tax receipts for the U.S. government. And when Americans get laid off, those Americans go on the government dole, which means the financial burden on the government goes up. The government's expenditures goes up, which means the government deficit gets bigger. Microsoft is contributing to that here by firing American workers and then replacing them with H-1B visas, all while telling us it's about saving money and continuing to burn tens of billions of dollars on data centers, something that is yet to really yield any major benefits for anyone outside of NVIDIA. So shout out to the Job Chick for correctly calling that one out. And last one of the day, guys, canned food producer Del Monte Foods files for bankruptcy. This is kind of interesting. Del Monte screwed over some of their borrowers, some of the people they owed money to recently. They got sued, and then they're like, nah, heck with it. We'll just file for bankruptcy. Canned fruit company Del Monte Foods filed for bankruptcy less than a year after executing a controversial debt restructuring. The firm entered a restructuring support agreement with lenders and started voluntary Chapter 11 proceedings to implement its terms, it said in a statement. It secured commitments for $912 million for debtor in possession financing, inclusive of $165 million in new funding from certain existing lenders. The development ends a challenging year for the borrower that saw its parent company, Del Monte Pacific, in June elect to skip a payment to the unit's lenders as part of a lawsuit settlement tied to a controversial debt restructuring. Del Monte said in a statement that the restructuring support agreement contemplates the company undertaking a going concern sale process for all or substantially all of its assets. Financing along with cash from ongoing operations is expected to provide sufficient liquidity during the sale process and fund ongoing operations. as it intends to keep serving customers. Del Monte executed a debt overhaul last year, which became the subject of a lawsuit by left-behind lenders who said the company defaulted on a $725 million financing agreement when it shifted the assets away from the reach of lenders. The strategy, known in industry parlance as a drop-down transaction, allowed Del Monte Foods to raise fresh liquidity by borrowing against the transferred assets. The deal also prioritized participating lenders via debt swaps and created different payment priorities, Bloomberg reported. So what Del Monte did is, they had this debt problem last year, and so they do this, what do they call it, a drop-down transaction where they shift assets to maybe other subsidiaries that are beyond the reach of their current debtors, and then they use those assets to borrow even more money, and then the money that they borrow, that gets a seniority treatment. Basically, they get paid back first in the event of a bankruptcy, screwing over their existing borrowers or their existing lenders. And, well, they sued them, and Del Monte's just said, you know what, we're going to file for bankruptcy anyway. So a staple of the canned food section may be going away. Now, they say they're going to keep operating. They have enough liquidity to operate in the short term, but they're also looking to liquidate everything. So you might be seeing those cans of Del Monte going away from the supermarket pretty soon here. And I just want to say thank you very much to M&J for gifting 20 Nobody Special Finance memberships. M&J, thank you so much for everything you do for the channel. And guys, make sure you say thank you to M&J for supporting the channel. Appreciate that very much, M&J. Okay. Also, M&J, thank you for everything you do as a moderator as well. That is a thankless job. Thank you for supporting the channel. Metal Seer says, are government reports accurate enough to count on? That's the question there, Metal Seer. Look, I've been pounding the table for several years now that the inflation data is flawed, that the jobs data is flawed. The data is what we have. It's the only indication we get. So the best way I could tell you to go about this is to actually open up the reports and actually look at what's in them. Learn how to speak government BS, because they can jar the headline numbers like they do with CPI, but they can't fake what's going on under the hood. For example, in the Non-Farm Payrolls report, they can use this game of downward revisions in order to make the headline number seem bigger. It's something that started really badly under the Biden administration, and the Trump administration has continued to do it in order to project economic strength. But then you look in the household survey and you can see the full-time jobs going away, the part-time jobs piling up, the gig work piling up. So you can see that it's not really a strong labor market. If you actually open up the attachments and look what's going on there, it's more time consuming and it gives you a headache, but the truth is hiding in there. And of course, like with the government inflation numbers, they constantly use these hedonic adjustments to make it look like inflation is worse than it really is. Are they accurate enough to count on? No, not really, but it's the best data we have. It's all we have. And so, you just got to do your best to interpret what the instrumentation is really telling you. It's a good question, and I wish it wasn't that way, because once the infectious stink of politics gets into your economic data, then the economic data becomes flawed, and a lot of economic decisions are made based on that data. If the data is not good, that means inefficient economic decisions are being made, which means money is being lost so politicians can make themselves look better, and, well, that's just stupid. Thank you, Metal Seer. Good question, sir. Appreciate you being a Melonhead member for 7 months. And Robert Feeds the Machine says, cheers. Salute to you, Robert. I appreciate the support of the channel and the good vibes, sir. Thank you very much for everything you do for the channel. And thank you, everybody, for having your coffee with the Melonheads once again this morning. Don't forget that like button and that subscribe button on the way out, should you feel so inclined. Thank you guys for the super chats and for supporting the channel, as well as you magnanimous Melonheads on Patreon and YouTube. Thank you guys for supporting the channel. Links down below to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.